I told you this was about to happen, and guess what? Back on June 23rd and for several of the following weeks, I published the first of several videos discussing the looming opportunity to make money in small cap stocks. And I followed a week later on June 30th with a video discussing how small caps would benefit from low inflation. Links in the pinned comments below. That all sounds like a lot of fun, but now let's discuss the potential problems that come with making money in small cap stocks and how to avoid them. Now notice I didn't use the word investing, and we'll talk about that later. Small cap stocks are often touted as high risk, high reward investments that can be enticing to many, quote, investors. Look, small cap stocks are like the Wild West of the stock market. They're full of unknowns and unpredictability, but they also have the potential for huge returns, which is what I think is their lure. Small cap stocks are essentially the little guys of the stock market, with market capitalizations of $250 million to $2 billion. They're often newer companies still finding their footing in their respective industries and looking to make a name for themselves. And because of their smaller size, they can move really quickly, either up or down. Fun on the way up and very painful on the way down. As I've mentioned in my previous videos, using small caps in your portfolio now is a 6 to 18 month trade idea and not a long-term investing idea. When it comes to putting money to work in small cap stocks, there are a few common pitfalls that investors need to be aware of, like higher volatility, lack of liquidity, and being more susceptible to market manipulation. The lack of liquidity and market manipulation are easy to remedy if you invest in the Russell 2000 ETF, IWM, or in ARK Invest's ARKK, which gives you exposure to higher risk, innovative companies, some of which are small cap. If we look at three of the largest small caps at about $2 billion in market cap, you can see that volatility here. Now, I avoided regional bank stocks for my examples because there are many in the Russell 2000, and I really don't want to look at those. I don't see those as great investment opportunities. Now, when we look at the other end, close to the 250 million market cap area, you can see the ride gets even wilder, both on the way up and on the way down. So what's the takeaway from all of this? Well, when it comes to small cap stocks, it's essential to do your research and understand the unique risks and benefits associated with these investments. Don't fall prey to the get-rich-quick promises of some of the small cap stocks. Instead, take a measured approach and protect yourself by investing in a small cap ETF like IWM. Also, as I mentioned in my two previous videos, this move into small caps is not a long-term investment thesis. It's a shorter-term profit or trading strategy that might continue to do well over the coming months or even longer. Are you currently invested in small caps? If not, are you planning to invest? Please let me know in the comments below. And if you're looking for more insights into the world of finance and investing, be sure to subscribe for new videos every week. With all that, let's take a look at the current health of the stock, bond, gold, and crypto markets. So I'm going to go through these fairly quickly this week. I think things are starting to show some signs of health in the equity markets, and you can see that over this past 5 days. Small caps launched higher, which is in effect increasing the breadth of the market move away from a few of the large cap index leaders. And if we look back over the past month, again, a similar picture. You can see small caps on the top, ARK Invest second. This is starting to look like a healthy appetite for equity risk. And then if we look at year to date, you can see that ARK Invest and small caps have a long way to go to catch up to the larger cap stocks. And then over the past year, very similar picture. And what about the bottom dynamics? Well, interesting. This is really looking encouraging. You can see that the bottom confirmation signal is up at 100%. It just shot higher in this last week. And you can see that the confidence level, which I was complaining about last week because it was down here in negative territory, is moving higher very quickly. It's up here just above 60%. Now, I'd like to see it get up here above 90%, and we'll see if that happens this coming week. But this looks very encouraging going into this coming week. And this is fully supported by risk versus opportunity. Look at this. You've got the S&P moving higher here, the black line. You can see that risk acceleration is in the basement. It's down here below 10%. This couldn't be better. And risk, which is very laggy, I told you this would come down, and in fact it is, and now it's collapsing. This is very, very encouraging. And then opportunity acceleration is staying up here above 70. This is very good. Now you can see that it started decelerating back here, and it's not moving up as much, but it doesn't have much more to go either. And you can see the same with the equity opportunity level, this blue line. It peaked out here and is kind of pulled back a bit. But look, it's up here in the mid 70s. These are really good indications that we have a good chance at the markets moving higher over the next several weeks. Now let's take a look at equity versus safety, and I'm going to jump right into the overlay. This looks really good. You can see that the NASDAQ 100 has been in first place for many weeks. It goes well before May 31st. You can see that the S&P 500 is in second. Now the Dow moved down to fourth, but that really got displaced. It got pushed down by gold, moving up into third. And what I like here is look at small caps from 10th to 8th to 5th place. Wonderful. And because the small caps moved up, they pushed cash down. Remember, cash doesn't move. It's flat. So something has to move it out of the way. And I like this. This is excellent. And if we look at the risk profile for safe haven assets, government treasuries, and gold, you can see how gold has moved up here. But you can see that cash got pushed down by IWM. Now, what I do like here, and this was the case a couple of weeks ago, is that intermediate treasuries are doing better than short-term treasuries. This is healthy. You want longer duration to be doing better than shorter duration. Now, TLT, 20-year bonds, and EDV, 20-year plus bonds, are down here at the bottom. So these have a ways to go before they move up here above intermediate and short-term and hopefully above cash. And how does all of this show up in the buying and selling pressure? Well, you can see that we had big peaks in the selling pressure back here for the Dow, but the selling pressure has been on a general decline while the Dow has moved higher. Similar for the S&P 500, upward move in price, declining selling pressure, buying pressure, this solid gray line, somewhat on an increase here. And then if we look at the NASDAQ 100, again, a similar picture, nice move higher, selling pressure on a decline, buying pressure increasing. Then if we look at small caps, Yahoo, hockey stick, big price move up, big move up in the buying pressure. And ARK Invest is a little slower to respond, but you can see we've had a very healthy move higher in the price of ARK Invest, and the buying pressure was well above the selling pressure. It's kind of collapsed here and is moving higher again on an upward move this past Friday. What about sector rankings? Well, you can see that sector rankings move very slowly. And last week, this was a very healthy relationship with technology, clean energy up here. This looks great. And then if we go to this week, you can see consumer discretionary moved higher. And again, a very healthy risk appetite going on here with cash moving down. But if you want to see kind of where things are headed, you look at sector rank acceleration. And let's just jump right into the overlays because there's a lot that really looks good here. So what looks good? Well, just about everything. You can see we've got technology all up here, ranked 1, 2, and 3. We have the S&P 500 getting bumped out by biotech. I'm fine with that. Got pushed down, but consumer discretionary moved up. Consumer staples moved up. We've got emerging markets moving up, emerging companies moving up, Bitcoin moving up, innovation moving up. The Dow stayed flat and cash really collapsed here. This looks really, really good. So what doesn't look good? Well, not much. Clean energy seems to be taking a breather here. Remember, the move to AI computing is driving clean energy and utilities higher in general because they take a lot of energy and electricity to power those big supercomputers. And then emerging companies, IWM, small caps, even though it shot higher, it moved a notch lower here. Now we're looking at two different metrics here in these sector rank acceleration calculations. So this isn't just price-based. And I'm guessing this is not really material here, that this got moved down a notch. Now remember, it maybe got moved down a notch because something else pushed it out of the way, not because this is not performing well. So you kind of have to be careful when you look at these. And how have Treasuries been looking? Well, if you look at the last 5 days, pretty good. Look at this. You've got the longest duration EDV on the top, 20-year TLT next, and so on. This is what you want to see. These are moving higher. And if these continue to move up well, you'll see that showing up in equity versus safety that we went through earlier. Now, if we look back over the past month, and if you've been following my videos, you know we've had a tough ride here. So these still have a ways to go higher, and hopefully they'll continue in this direction. And then if we look at year to date, you can see we're still underwater. And then if we look back over the past year, you can see we're still underwater, but things are starting to move in the right direction here. And how does this show up in the buying and selling pressure? Well, you can see that short duration treasuries have been moving very nicely and steadily higher with low volatility. You can see that intermediate treasuries, a little more volatility, but the price moving higher. Now, what I don't like here is I don't like the fact that as the price is moving higher, the selling pressure, this solid orange line, is also moving higher. So we have somewhat of a divergence here. I don't like this. Now, when we move out to 7 to 10-year treasuries, which I call intermediate to long duration, you can see the ride gets a little choppier, but look at the buying pressure just shooting higher here in the last several days as the price moves higher. Somewhat of a similar picture for 20-year treasuries. Price moving higher, and the buying pressure well above the selling pressure. So this looks really good for longer duration treasuries going forward. And what about that yield curve? Well, wow. Look at this. We were almost 50 basis points inverted just several weeks ago, and now this has collapsed to only 27 basis points of inversion. This is a big move, and this is really positive going forward. Well, why has this happened? Well, interest rates at the short end, where the Fed controls them. Now, the Fed controls at the very short end, which isn't on this graph. But you can see that in anticipation of the Fed lowering rates, because of better inflation numbers coming out, you can see that the rates at the short end have really fallen here. Where was this a year ago? A year ago, this was at 5.326%. A month ago, 5.11%, and now 4.88% today, this solid blue line. So this is really encouraging. And why is this? Well, let's take a look at the Fed rate monitoring tool. So the Fed meets in 2 weeks, 3 days, 5 hours, and 30 minutes from now. And you can see that the markets think there's a really strong possibility that the Fed's not going to change rates. And I tend to agree with them. And because the market feels this way, the Fed is unlikely to go against what the market's thinking. They don't want to jar the markets. But let's go out to September. And if you go out to September, this number that indicates the Fed's going to keep rates exactly where they are now, a week ago was at 22.3%, and several weeks ago was up at 40% or almost 50%. Look where it is now. It's at 3.8%. That means that there's a 96% chance plus that the Fed will lower rates in their meeting in September. And you can see that here. Now, if we go out to November, there's almost no chance rates will be where they are. In fact, there's a very good chance, better than 50% chance, that the Fed will be lower by 0.5% by then. And what about gold? Well, gold has been trying to rally here. You can see it's a very volatile rally. It's pretty jagged, but the buying pressure is well above the selling pressure here. So this solid gray line is the buying pressure. And you can see that it has been trending higher recently, while the selling pressure has been trending lower. So this looks like gold could continue to go higher. Okay, and what about Bitcoin? Well, as you can see, Bitcoin has just been on a collapse here, a very strong downward move. And you can see that in the selling pressure, which bottomed out back here, way back here, almost 2 months ago, and has just steadily been increasing and going higher. Now, this is starting to balloon to a point where it's likely it's going to start to reverse and collapse, and hopefully that'll cause the price of Bitcoin to move higher. Now, this isn't necessarily off the charts here. It can move quite a bit higher, but usually when selling pressures get up into this range, unless there's a huge event that really drives the selling pressure higher, the selling pressure will start to move lower and the price will start to move up. Look, the markets have been a little bit scared because the big run-up so far has been concentrated in just a few mega cap companies at the top of the S&P 500 and the NASDAQ 100 indices. It's healthy that the market breadth is starting to broaden out and move into small caps, and hopefully this recent sharp upward move will continue long enough to lock in some big profits over the next months or even a year or more in small caps. Even though small caps appear to be presenting a short-term trading opportunity, I still caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.